Hi again, I'm Kortsch from the Monetary Trust Initiative, and remember, this whole series is how to take care of our infrastructure and in the process create several million jobs. So I'm trying to tie four things together: our infrastructure, which I finished, our monetary system, which I'm largely through, the rate of inflation, and the balance sheet of the Federal Reserve Bank. So this is continuation on the second point, the monetary system. And in the last video, in a very quick overview, kind of embarrassing how fast it is, I went through the fractional reserve banking system, what are reserves, what are deposits, what's a bank balance sheet, how loans are made, and how money is created and destroyed. Okay, let's keep going. If that didn't make your hair stand on end or whatever, then let's look at why the system has worked, because it has, by and large, here we are, 100 years after the Federal Reserve Bank has been created, a little bit over how it was created in 1913. And there have been some real massive instability points, like we've had a few years ago, the 2007-2008 crash and the Great Depression, etc. But, there's a lot of good to say about the system. So obviously, there are control functions within the system. And that's what I want to talk about here, control functions and then some problems with those. So basically, it's a value matching system. So what do I mean by that? Well, what we produce in GDP, the goods and services in the country, are matched by the amount of money that we create through this debt-based system that I explained in the last video. And as our production increases, then in theory the amount of money increases, or if our production were to decrease, like in the Great Depression, whatever, then in theory our money decreases. So the point is to create a steady value and maximize employment as much as possible. That's what we're trying. That's what I'm talking about, value matching. Okay, how is that done? Well, largely by the interest rate, by the Federal Reserve Bank. So the Fed sets an interest rate, or the ECB in Europe, or the Bank of Japan in Japan, etc. And what happens is when things get too hot and inflation starts rising, the Fed raises the interest rate. And you say, well, that's counterintuitive. So, whoa, they should lower the rate because that means my loans get cheaper. No, because remember, money is created through debt. So if the interest rate is raised, less debt is created because you don't want to borrow the money anymore, and therefore less new money is created, and it slows the economy down. So it's mostly through interest rates. Okay. The other control function is profitability of the banks in a competitive market. Remember, the banks want to maximize their loans all the time. So they want to drive higher inflation, so to speak, from their business model, because the more loans they have, the more money they make, and they want to make money. But here's the crux. Those have to be good loans, because they want to be able to deal with clients who can pay their money back and make the bank a profit through their interest payments. If the economy is bad, then the profitability of the banks is not that good anymore, because there are not that many good borrowers. Right? And it's exactly the same rate. Remember, raising the interest rates does exactly the same thing. And the third item, and this is really quickly on a sort of a overview, the banks are constrained by capital and liquidity provisions that are done by each country and also by the central bank of the central bank, which is the Bank of International Settlements in Basel. I want to tell you, a control function is not by holding back reserves. There's a popular theory out there, money multiplier theory, and I already talked about it last time, that thinks that the lack of reserves constrains bank lending. It never does. Trust me on this. I'm going to give you a quote right away to show that I'm right. All right, which is why there's fear in certain quarters of hyperinflation, because through QE we created 3 trillion of new reserves. Therefore, with a 10% reserve ratio, remember we went through that in the last video, technically, if there's only 10% reserve, then we could create $30 trillion worth of new loans. Ladies and gentlemen, not happening. You don't see it. It's not out there. Loans are not constrained by reserves. Let me quote again from the Bank of England. And again, it's not simply for a British audience. It's exactly identical here, but they simply have some nice individual quotes that I can give you. So this is from the paper that I mentioned before, Money Creation in the Modern Economy. Here's the quote. Reserves are, in normal times, there are abnormal times, such as QE, etc., but reserves are in normal times supplied, quote, on demand to commercial banks. In no way does the aggregate quantity of reserves directly constrain the amount of bank lending or deposit creation. It does not constrain it. Let me put it in reverse. If it does not constrain it, it also does not create it. That means we are not creating a hyperinflationary environment. All right, but there are issues, there are problems with this control mechanism. Okay, everything isn't honky-dory in this land. Let me go through just a few of those. If you think of the fact that money is created through debt, then problem number one is this has to lead to ever-increasing debt levels due to the needed interest payments. Back to the car loan that I mentioned in the last video, if you borrow $30,000 and you have to pay $3,000 in interest, I know it's a high interest rate, but nice round numbers. Somewhere that other $3,000 has to come from. Where does it come from? That debt has to be created, because that's how we make money. I don't mean make money by earn money. I make money by creating money. All right? That's problem number one. Problem number two, it demands growth. We are driven by growth. But if our population were to stabilize, where would that growth come from? Growth only comes from two aspects. From our production capacity with respect to population, and our production capacity from an hourly basis as to increase in capacity. Okay? You can't keep on doing that. The third problem is especially the interest rates. There's a huge lag between when the Fed takes an action and how that affects things on the street. That lag is up to 2 years. And you can go on the Federal Reserve website, they'll tell you that themselves. And the fourth problem is procyclicality. These $63 words. What it simply means, it's the system that we have punches cycles up and down. So if we're in a good business cycle and things are really going great, this method of making money goes things even higher. Then we start crashing and it makes things go even lower. So that's pro for cycles. So this naturally amplifies the business cycles. That's not good. Creates unemployment, creates bankruptcies, creates people losing their homes as we lurch up and down in our economy. There are better ways of doing it. I want to talk about those. By the way, just as I said for the last couple of videos, look at my book if you want to get a whole lot more information on this. And in the meantime, hang on. Some more good news is coming. I'm Kortsch from the Monetary Trust Initiative.